Hi, all. A very, very good evening. Let's just wait a minute or so and give our fellows, some time to join, and then we'll begin. We'll just begin in a minute or so. Thank you for your patience. Great. I think we have a few people in, and a lot of them are joining now. So let's move on towards the starting of the session. First and foremost, McGraw Hill welcomes all of you, especially the attendees and our honored speaker, Professor Prakash Singh from IIM Lucknow, for joining us today for the webinar on the rise of intangibles, what the balance sheets don't tell. Our speaker comes with a vast experience in industry and teaching. Besides teaching various courses in the domain of finance and accounting at IIM Lucknow, he is also the convener of SciFi, SIDBI Center for Innovation and Financial Inclusion at IIM Lucknow, which is sponsored incubation center for promoting startups in the space of fintech, agri-tech, rural livelihood, and women empowerment. Today, we welcome him to share with us his views and insights on how recent developments in disruptive business models and technology, or rather intellectual capital driven businesses, the role of intangible assets have become more predominant. He also quotes firms like Facebook, Uber, Twitter, Flipkart, etc. are just a few examples of how firm valuation is driven more by intangibles rather than tangibles. Let's hear more from our speaker. Stay tuned to enjoy the session. Over to you, sir.
Okay, thank you, Prakriti. Uh, Thank you, McGraw Hill, for arranging this webinar. Before I start, I would like to tell you something which is very important, which is that I teach accounting, and as you can see that I have co-authored a book also on accounting. But what I am going to talk about is largely not very something very positive for people who teach accounting. So all those attendees who are joining and who have something to do with accounting would not be really very happy listening to what I'm going to talk. And that's a disclaimer which I wanted to start with so that people don't feel sad about it. The fact of the matter is that the way business models are evolving, gradually you will see lesser and lesser role of accounting coming into picture. Okay, let's get starting with some of the key issues which I wanted to highlight today. The essential thing is that whenever we talk about firms, it's always about what is the value of the firm, because the most important uh, stakeholder is always the shareholder, and therefore the most important criteria for deciding a firm is always its market value. And when we say market value means what is the value which the market has given to a particular firm. And therein, the accountants played a very important role, because we always thought that that whatever a value a firm derives in the market is largely driven by what is reported in their financial statements, which, for the purpose of understanding, is balance sheet and the income statement and the cash flow. Now, we have grown by hearing these things, that the financial statements drive the value, and if the financial statements look bad, then the firm valuation would also be bad. But what we are seeing in the last few years is something very contrary to this. There are firms which are getting or attracting very strong valuation, do not have much to talk about in their financial statements. And that's where the concern or doubt exists now is whether accounting will remain relevant going forward. And that's a very important question which we all need to ask ourselves. And being a professor of accounting, it is something which is continuously keeping me thinking about what would the future of accounting when financial statements gradually become irrelevant. Okay. So the first quote is from Bloomberg, and if you can just read through it, you will understand what I am talking about. You'll get a sense of it. Take all the physical assets owned by all the companies in S&P 500, all the physical assets, all the cars and office building, factories and merchandise, including the inventories, and sell them at a cost in one giant sale. They would not generate. They would generate a net sum that doesn't even come out to 20% of the index 28 trillion dollar value. It basically means that the index is deriving a value from things which are not getting reported, which are not tangible, and much of what's left comes from things you can't see or count, like algorithms, brands, and lists. So that is something which I wanted to start with, so that you get a hang of what exactly is the focus of this discussion today. That more and more organizations are getting valued not on the basis of what is the tangible assets which they have, what are the physical properties or the factories or the inventories they have. They are getting valued by more and more intangibles which they have. The new assets are ideas and innovation. They are the world's new capital. In the past, physical assets such as plants, property, or machines made a bulk of the company's value. Today, intellectual property such as patents, trademark, goodwill, and even data and software have increasingly taken center stage. Now, this is where the shift is happening in a big way, moving away from things which are tangible to things which are largely intangible. To just give you an understanding of what is happening here, if I just give you two data points, in 1985, the five biggest companies in the world were in the US were IBM, ExxonMobil, GE, Schlumberger, and Chevron. Massive firms. I don't need to tell about what kind of tangible assets they would hold. And just fast forward it to 25 years or 25 years, and the five biggest companies today, and you know it, they are Apple, Microsoft, Amazon, Alphabet, and Facebook, who coincidentally derive a majority of their values from intangibles, which are not coming from tangible assets. Their value is coming predominantly from intangibles. And that's the whole point which I want to emphasize here. I mean, sarcastically being said, they have done nothing but be getting bigger since then, grabbing market share in the lockdown and pushing their weighting. In the lockdown means the current pandemic which we are facing, and pushing their weightage in the S&P to 23%, and approximately half of Nasdaq 100 is made up of these firms which have largely value coming from intangibles and not tangibles. Another chart basically to identify the same trend and not really pointing out almost similar thing being pointed out, tangible versus intangible assets. 75, 85, 95, this is the timeline in which things are moving. And if you can see the numbers more carefully, somewhere in 85 the total value was, let's say, 1.5 trillion, out of which 1 trillion was tangible and half a trillion was intangible. This is 85. In 2005 it becomes 11.6 as the total value, 11.6 trillion. Intangible is 9.28. In 2018 the total is 25 trillion. Again, the intangible is around 21 and tangible is just 4 trillion. So you can see how the intangibles have completely overtaken the center stage in terms of the total value of the firm in the markets. Now, this is an interesting slide where we talk about the valuing the various intangibles. And just to give you some idea about people who are not from an accounting background as to what are these intangibles most likely talking about, it is intellectual property, it is brand, it is goodwill, it is software, it is rights, it is copyrights, it is all those stuff which is getting more and more dominant. And what you can see here again, the same thing getting reflected. The tangibles fall behind the intangibles, and the intangible keep on creating. So this is basically the set of intangibles which are becoming dominant, and the tangibles part losing their relevance gradually. Now, let's go back to the book and say, okay, let's see what exactly the balance sheet has to talk about. And because for people who are from pure, not maybe not purely from accounting, they would be thinking as to where is this all leading us to. So, if you look at the balance sheet in terms of performance, now book value of equity is read as uh, uh, book value of assets minus book value of liabilities. And herein I am giving an example of a firm, which you will very shortly see what exactly is this firm. So you can see the assets of this firm is around $286 billion, and they go primarily into PPE, which is property, plant, and equipment, the tangible assets, the inventory of the merchandise, the trade receivables, and the investments, and also, of course, the intangible assets like brand, patent, trademark, and goodwill. So if you see, the asset value is 286 billion and the equity value is 102 billion. So we can very clearly make out from this that roughly the value of liabilities would be around 180 or so, which is subtracted from the assets to get the value of equity. So on the books of this firm, the value of equity is close to 100 billion. But when I look at the market value of equity, the market value of this firm is 1618 billion. Now, look at the multiple in which the book value and market value are currently trading. So, market value is 1618 billion and book value is approximately 102 billion. So, roughly 16 times, if I can approximate it. So there is something which is not getting reflected in the balance sheet, because the balance sheet tells me that the total value of the firm in terms of the book value is around 100 billion, but the market is giving it a valuation of 1618 billion, which means that essentially market is putting a multiple of 16 times on your book to buy those stocks or to value the firm. And therefore, when I'm saying the market is ready to pay 16 times the book to buy one share, there's something which is not reflecting in the book, and that is something which we keep on emphasizing in the class, that when financial statements do not disclose the real value of the firm, gradually the power of financial statements is reducing when it comes to valuation. So firms will prepare financial statements, no doubt about that. Firms will continue to report balance sheets and P&L as part of their compliance requirement, but that will not really help much when it comes to valuation, because you can very clearly see that a firm which has a book value of 102 billion is actually getting a value of 16 times more than the book. This is the firm which I am talking about. If you see clearly here, 28.6 billion is the just a second. Yeah, 286 billion was the assets. So this is 286 billion is the total assets. and the total liabilities is 184, bringing down the value of equity to 102 billion. So this is a firm which I was talking about. 286 assets, 184 liabilities, 102 equity, and you just saw 286, 102, and market value 1680. No prizes for guessing this. This would be primarily a technology firm, somebody like Apple or Microsoft, who is doing this kind of a uh, balance sheet. And if you look closely on the balance sheet, you will see that there is a, if I just try to break the asset side, which is roughly 286 billion, if you see here, the investments in items like cash and cash equivalents and short-term investments is around 133 billion. So if I don't disclose the name of the firm, sometimes we get an impression that is this firm an investment bank because they're holding so much of investments. Almost half, 286 is the total assets, 133 sits inside cash equivalents and short-term investment. So when half of the asset book is lying in cash and investments, you get a feeling sometimes that is this a bank which we are working on, because the size of the investments and cash portfolio is so large. So not only the balance sheet is not able to tell me the correct valuation, it is also not able to give me an idea of what is the business model or what is the product or service which this firm is offering, because I don't really see that reflecting in the balance sheet, which was so easy to look forward to just 10-15 years back, that when we looked at the balance sheet, we could tell what kind of firm this is, what do they produce, or what would they normally be getting into, what line of business, which is becoming increasingly difficult, because you can very clearly see it here that out of the 286 billion dollar worth of assets, 133 sits inside investment portfolio. Sometimes, many times, we'll get an impression that it is not really a firm which sells any product; it is more of a investment bank. But actually, the picture is that this is a firm which manufactures the iPhones and the iPads. So this is Apple. Now, coming back to the previous discussion, therefore, the previous slides, if you see here closely, what is happening is, and I want you to look at this point carefully, because there would be people who would say that the 1618 billion market value is not really making sense. I completely appreciate the point which is made when people say that these are abnormal valuations, and some people go to the extent of calling it a bubble and so on and so forth. But the fact of matter is, you may disagree with these valuations, you may call them a bubble, you may call it abnormal valuation, irrationality, but the fact of the matter is that this is the valuation as we speak. So there is somebody who is ready to pay that price. If I am not ready to accept that price, that's my problem. I can stay away from these kind of markets and say I don't understand the pricing. But the way these things are shaping up, 1618 billion is the price today as we speak, and therefore this is something which cannot be challenged. How has this been arrived at is something which we can go on debating, but the fact is, at the end of the day, that's the value which the firm commands in the markets today. And whether we like it or not, this is driven primarily by things which are not getting reflected on the balance sheet. Some of them I have written here. For example, it is driven more by intellectual capital, future growth prospects, user data, monetization opportunities, etc. Uh, one of the major reasons why this valuation becomes so large as compared to the book value is also because of the fact that the intellectual capital is not actually recorded in the books, in the financial statements. For example, human resource, and we all understand that these industries like Apple and Microsoft, they are people driven. They were driven by the top engineering minds which are working there, and if they are not getting recorded on the balance sheet, then there is definitely some signal which is missing, which is not going to the market when it comes to valuation. So it's very obvious that things which are not getting captured on the balance sheet will therefore be reflected in the market value, and market will give a valuation which is much higher than what is being reflected in the books, because they know that the book doesn't reflect the true potential of the firm going forward. Similarly, there is another firm which I have picked up. This is my one of my favorite firms in the automotive space, and we all love this company called Tesla. Again, if you see here, the uh, total value in the balance sheet is around 338, and they have liabilities of 248. The equity value is just around 90,000 something, 90 billion. But if you check in the market again, Tesla would be commanding a valuation which is much larger than what is there in the books. So essentially, by showing you these two balance sheets in terms of what do they look like on the books and what do they have actually in the market, we are trying to say that these companies have really shaken up the confidence which we used to have in the balance sheet and financial statements, because they are driven by factors which are largely intangible. So we all know what Tesla does and what kind of novelty and what kind of disruption they have brought in the conventional automobile industry. Now everybody and anybody in the automobile industry is talking about EVs, which was not being spoken of 10 years back. So they have Tesla has come on stage, disrupted the whole thing, and forced everybody to talk about EVs, and that is how their valuation is still very very high as compared to the other players in the industry. Although their balance sheet may not be as big as the General Motors and the Fords of the world, but they still get better valuation than these companies, predominantly because of the disruptive technology business in which they have become almost like a game changer in the automobile industry. So by just citing these two examples of Tesla and Apple, I was just trying to tell you that how has balance sheet not been able to show up the entire potential or the entire valuation of the firm, and there are many other things which has to be taken into account when you look at the entire value chain of such firms in the current business environment. Now let's look at a specific example to drive home our point, because this is an example which everybody can relate very easily. And back home in India, this is something which is very, very debated and discussed in so many user platforms. We all know that what happened in 2014 was Facebook, Mark Zuckerberg announced that it plans to acquire WhatsApp at a purchase price of 16 billion, wherein 4 billion was paid in cash and 12 billion was paid in terms of shares of Facebook for the shareholders of WhatsApp. Now, by and large, in my country, WhatsApp is seen as a free app, although in some parts of the world it is charged, and they even tried that in India also initially, particularly for the iPhone users. But largely in India, WhatsApp is seen to be something as free, and a free app which allows people to send text messages, video messages, audio messages, now getting into video chats and all that stuff, is being bought by a company called Facebook at a price which is, I mean, if I convert this in Indian currency, it would be more than 100,000 crores, which is very very absurd and irrational valuation. Again, talking about people who don't understand the valuation part would see it as happening. Because the other thing which we also want to point out here is WhatsApp's 6 month revenue for the first half of 2014 when they were acquired was just around 15.9 million, and the company incurred a staggering net loss of 232 billion. So on a revenue of 15 million and a net loss of 232 billion, you are being valued at 16 billion. Now, how can somebody really explain this transaction to an old school like me who studied accounting 20 years back, and they are not able to understand how can a firm which has not even produced $1 of profit till now is being valued in $16 billion. And the I mean the swords can be drawn out, and we can criticize Mark Zuckerberg and say that this is absolutely useless purchase which they did, and all the people who had negative opinion about this purchase would be embarrassed to find out that if I look at today's valuation, actually Facebook has done a good deal, and they have actually got it at a right price, because the current valuation of WhatsApp is more than at what they acquired, which is 16 billion. So just look at just one example, and we'll try to understand what exactly was Facebook buying when they buy a free app, free text messaging app being bought at $16 billion, and that app is uh, just doing 15 or 16 million revenue and a net loss of 232 million. Take it to an old accounting school professor, he or she would not be able to make any sense of it, and they'll say either the valuers were very high on alcohol or something, and how can they bring that kind of valuation to a firm? But this is what has happened. Okay, and we all know it is doing quite good. So, what did Facebook buy actually? So that was a question which we keep on answering. That when you pay 16 billion for something, you must have thought about it as to what are you buying. So, of course, they bought something which was tangible, which was WhatsApp technology. So that is the tangible part of it. The first bullet is giving us a lot of comfort that they bought something tangible also, which is the technology part. But the main thing which drove the price or which drove the valuation to 16 billion was not the WhatsApp technology, it was something else. And that something else is what is listed subsequently. So, what did Facebook buy? They bought users. They bought the users' data, which is immediate and substantial overseas market penetration. So, Facebook through WhatsApp could now reach to various markets which they didn't had any presence, because WhatsApp was there but Facebook was not there, because even if Facebook was there, Facebook was seen more as a web application rather than a mobile application. So people used to log in Facebook, but they used to log in from a desktop or a laptop more or iPad, wherein WhatsApp was seen more as a mobile app. So in one go, when they acquire, they not only see a huge overseas market penetration, they also buy a huge presence on a mobile device, which is the fourth bullet here. The presence on mobile device as a diversification from beyond web presence. So I had only web presence, now I have a mobile presence also. That is what is Facebook actually buying. And what they are also buying is the third bullet, which is the future prospects of monetization of users' data. We're not saying that they will monetize this data, but I'm saying there is a prospect of monetization of this user data, a pure data play, access to mobile numbers, and the moment you install WhatsApp in your phone or your device, the entire users list is also gone. So not only they have access to your mobile numbers, they also have access to the users contact list. And that is what Facebook is buying. Facebook is also buying the growth rate, because Facebook somewhere down the line has realized, and even I have started feeling this, that Facebook is gradually realizing that there is a growing uh, kind of a fatigue which is coming in the Facebook users, that they're not able to see anything really very and exciting coming on Facebook. And if you talk to younger audience, for example, my son, when I talk to them about Facebook, they come back and say Facebook is more for uh, people like you and uncles and aunties. The young kids are not there on Facebook. They have moved on to something like Instagram or Snapchat more rather than on Facebook. So Facebook realized this, that they might be hitting a plateau, and therefore there is a need to connect with the younger audience, and therefore WhatsApp was one of the good things to do. The other strategic reason which I have observed over time while discussing with strategy people is Facebook also went ahead and bought this because they wanted, because they knew that if they don't buy, somebody else will buy, and that somebody else was nobody else but Google. So they were seeing an opportunity that Google might jump and give a price to WhatsApp. So before a Google makes an offer, let me go and make an offer and buy it. So that is the strategy part of it, which they were trying to buy by giving it. By keeping Google out of the social media space, and Google still doesn't have that thing in their portfolio. Uh, of course, Facebook has earlier bought Instagram also, so you know that story also. What was Facebook also buying was market reputation, and Facebook was also buying human resource talent because WhatsApp, I am told, is run by almost 50 or 60 engineers. That's it. So 50, 60 engineers and human resource talent. There is huge talent which the uh, uh, WhatsApp is buying while doing this. So in a way, that 16 billion price tag which WhatsApp had when Facebook bought it is being justified by saying that Facebook did not buy WhatsApp technology only. Facebook bought WhatsApp because there was huge potential to explore, to exploit in terms of the user database. And how are they going to do it? We'll have to wait for a few more years to see that. I think there is already creating a separate app for WhatsApp for business, where there is no limit on number of users who can join a group, and all those differentiation will start, which happens normally in a subscription based model, that initially it will be free, and gradually, as and when there is a critical mass of people or users, then they will start differentiating, and they know that people largely love differentiation. They will create layers which everybody else has done. For example, Amazon says Amazon Prime, Netflix has that, Zomato has that. So gradually, I see, I'm not sure, but WhatsApp will also do something similar, that right now it is free for everyone. Gradually, they will make it paid, and the paid version will have definitely better features than the plain version. Plain version might also have advertisements. So to avoid advertisement, you may have to graduate to a paid channel. And paid channel of WhatsApp would be very nominal in the beginning, maybe something like 500 rupees or 1000 rupees per annum, and gradually they will, encourage people to shift to the paid one. That is how I see the monetization of the whole thing, that how will they graduate. And of course, that is a very long call as to what do they do with the data of the users. Are they going to share it with third parties? That is something which is still not, uh, we are not very sure about it, because that would be something very difficult for WhatsApp to do, or Facebook to do, to share the users' data with a third party. Although in India, data privacy rights are not that strong as compared to developed economies like US and the Europe, but I think that would require a very serious discussion with the state and the regulators when they actually try to monetize the users' data. So that is something which is a long call. But as of now, what I can clearly see is that they will definitely create a differentiation. So when you hear that Facebook buys WhatsApp for 16 billion, they're not buying a product, they are buying the future audience, market reputation, potential for going into beyond web, and so on and so forth. Let me bring another context to this discussion, because most of the time our discussion focuses on something which are on issues which are more glamorous. Let me bring some issues which are not so glamorous, but they make a lot of difference. And particularly in the developed economies, again, there is a lot of focus these days on what do firms do as a part of being sustainable. And when we talk about sustainable, we are not really talking about being profitable, because oftenly this word sustainability is confused with being profitable. When we talk about sustainable, we talk about largely the ESG initiatives, which is what is the firm doing on the environmental front, what is the firm doing on the social front, and what is the firm doing on the governance front. So ESG initiatives are becoming very, very critical, And of course, it will still be early days in Indian firms. Large Indian firms are aggressively pitching on ESG, but for global firms, it is already there. It is part of the disclosure requirement. It is part of their uh, mandatory disclosure in the annual report. It is there in India also, but the it is not getting the desired or the required attention which it should be getting. It will take some time. But if you see why I'm bringing it here is that none of these ESG initiatives, for example, if some firm talks about that they are building offices, wherein the offices will have more of green buildings, where there will be less of use of power during the day, and I mean almost for 60 to 70% of the office time, the natural sunlight would be enough to work inside the office. That is called, well, just one example from environmental initiative. Similarly, from a social initiative, if I say I'm bringing in more diversity in my employee pool and I am bringing in more women in my board, let's say, these are again intangibles. The point which I'm trying to say is that it has been proven empirically, it is not my own belief or I think so. It has been proven empirically that firms which get into aggressive ESG initiatives are rewarded in terms of better market performance, not accounting performance, market performance, the valuation in the stock markets. Now, again, there is a reason to believe that the intangibles are driving the valuation. And this is the another way to look at how, again, things which are not reflected on the balance sheet, because a organization pitching for gender diversity, this factor will not show up anywhere in the balance sheet or the P&L. Similarly, a firm which has more independent directors in the board, and a firm which brings in self declaration on part of the board members about bribery and corruption or political lobbying, these things don't get reflected in the balance sheet. They don't get reflected in the financial statements. If you are doing something about reducing the level of water use in your factory or office, again, these things don't get reflected in the financial statements. But when you report them as part of your ESG reporting, they definitely attract investors' attention, and investors put a premium on the price because you are doing such things. So again, you see that uh, issues which are not tangible, which are intangible, are adding value to the firm. So what you do in terms of manufacturing cars or manufacturing trucks or manufacturing an aircraft is one part of the story. The other part of the story is how much do you care about your employees, how much do you care about the environment, and what kind of governance structure do you have in the firm at the top level. These three things are also, I'm not saying they are the only thing, these are the things which are also adding value to the firm, and they are largely intangible. So contrast this example with what we saw just now with Facebook example, and you will get where I am coming from. That things which are intangibles, things which are difficult to quantify, things which will always have a challenge in terms of how do I show it up in my financial statement, because they are nowhere in the financial statement, but they are somewhere else in the annual report. These qualitative factors will have a very large role in deciding the firm value beyond what is there in the financial statement. We are not discounting the role and the importance of financial statement. They will always there and they will always be there. But over and above what was disclosed in financial statements, these items are also becoming very, very important. So how transparent you are, how trustworthy you are in terms of building the trust with the society, that is also getting reflected in the better valuation of the firms, which is again an intangible. Okay, so this is the second part of the discussion. The first part of discussion was on that tangibles are going down in terms of total valuation drivers. Intangibles are becoming more and more critical. What does it mean for us? So I will start with what does it mean for the global economy, and then come down to what specifically it means for us as professors of accounting and people who teach accounting. Now, For the global economy, this is not something which is a good news. So I'm not a pure economist, but what I can see is the problem with intangible assets is scalability. Scalability is very easy to do for an intangible asset without investing a lot of money capital. And this is something which is written by this very famous author, Capitalism Without Capital, which I am heavily influenced by, and I will definitely recommend all of you to read that book. So what happens is, when I'm talking about a tangible asset and an intangible asset can bring in that scalability very fast, and a tangible asset cannot bring that scalability so easily. So if the economy shift from tangible to intangibles more, definitely there would be an impact on employment, because not everybody in the society out there is ready for an intangible, because intangible is largely driven by people who have more knowledge, highly educated, more intellectual and technology driven. Not everybody is prepared for that. So one of the main ways intangibles restrict employment and other growth measures is their scalability. A product whose value is derived entirely from a formula, like a drug or a software, can be sold million of times with minimal additional investment. You're already seeing this. For example, the COVID vaccine, which we are talking about Pfizer and Serum Institute and all those, the one formula can be multiplied millions of times in a very small investment. The most important thing is the formula, the drug, the molecule. Once that is ready, making millions of copies would be very easy. That is not possible with a tangible asset. Read the next line. However, tangible assets are not scalable. For example, one can use a seat in an airplane only once or twice a day. You cannot sell the same seat 5,000 times a day. That is a problem with tangible asset creation. And that is why you must also think that why do capital investments are giving, investors are looking at more and more companies which have less of tangible asset and more of intangible assets. There is little doubt which model the stock market prefers this year. Investors have been falling over themselves to reward businesses that de-emphasize humans. Uh, People are being kept at home. We know all what is going around. Companies with fewer digital capabilities have struggled. Firms that rely on their employees compared with intangible assets have been beaten, and they have beaten labor intensive ones by 37 percentage points in 2020, according to an analyst. So basically, what we are saying is, the shift from tangibles to intangible is not good for the economy in the long run, particularly for countries like India, where we are not prepared for that level of transition, because it definitely has an impact on the number of employment which we can generate. If a tangible business will definitely have a lower ROI, because the investments required are very large, but at the same time they generate more employment. Intangible businesses will not be able to generate that kind of an employment which a tangible business could create. This is the global map for. This is again picked up from the Lev book of End of Accounting, which is another very good book on accounting. And I personally love to challenge myself when I go to the class and teach accounting. I carry a book called End of Accounting that sends a very strong message to the student that the professor is teaching accounting and he's bringing a book which says the end of accounting. That is how you keep on challenging yourself. And you see here the tangible investment rate and the intangible investment rate, and you can see the picture is self-explanatory. Where is the money flowing? Money is flowing largely in the intangible category, and the tangible investment rate is going down. Very simple logic. The ROIs on tangible investments are going down, and it requires huge investments, whereas in intangible, the amount of investment required is less. So investors clearly prefer intangibles over tangibles. The other challenge for intangibles, which creates a maximum confusion for professors like us, is how do I account for it? Accounting of intangibles has always been a challenge. For those who are professors of accounting will appreciate this better, or students of accounting, that uh, as per the accounting standards, internally generated intangibles are not allowed to be recorded. If you acquire it from outside, you can record, but internally, if you generate an intangible, it is not recorded. So firm values is created by smart people armed with best technology, developing new products. Plant and machine think that make noise when they fall hardly create any value. So the intangible pattern isn't surprising. What is surprising is the accounting treatment, which considers internally generated intangibles as regular expenses. Yeah, this is the point which I was trying to emphasize. The GAP says that internally generated intangibles as regular expenses, they will be treated as regular expense. So if I keep people on R&D and pay them salaries, and they develop some product or a drug or a formula, their salaries is not treated as a balance sheet item. They are expensed as regular expense, whereas tangibles are considered assets. So if I buy a plant or a machinery, it is an asset. If I pay my scientists and engineers on developing a drug, it is an expense. So the balance sheets are not reflecting what exactly is required. For example, corporate balance sheets proudly exhibit industrial age buildings, machines, and inventory, while patents or leading brands are on the balance sheet. So if you look at one last time at the figure, you realize that reality, that corporate performance, this one, the last slide, financial information goes down and corporate information goes up. So essentially, the accounting of intangibles is also not something which is very comfortable, because we still don't understand that when I say the firm is trying to build in a product or a software or a drug or a molecule, it is not reflected on the balance sheet. If you acquire it from outside, it is accepted as intangible in the balance sheet. So that's a concern from an accounting lens purely, uh, which is sometimes also called internally generated inherent bias in the rules, which acquires intangibles are capitalized. Um, Companies cutting intangible investment will report earnings increases. So if I cut down Pfizer, for example, cut down R&D by 25%, it would be better for them. And if it is, I mean, basically we are saying that Pfizer should not be spending so much on R&D. Rather, you should be trying to acquire a formula or a drug from somebody else who is building it. So if a small organization is building it, acquire that organization and keep it on your balance sheet as an intangible asset rather than you developing it. Because for you to develop it, the expenses would be treated as any regular expense. And that's a very sharp difference which they have created between Boeing and Lockheed here. An example which I picked up from the web says that Boeing develops internally most of its strategic assets, whereas competitor Lockheed Martin primarily acquires such assets. Now, accounting rules makes Boeing's ROA seem substantially lower than Lockheed Martin's, but this is just an accounting artifact, not reality. So if you look at accounting, it will always put Boeing in a bad light because Boeing has been developing most of their assets, whereas Lockheed Martin is acquiring most of the assets. So when you acquire, it is there on the balance sheet. When you develop internally, it is just another expense. So somewhere there is inherent biases against intangibles spent by the firm themselves, rather than if they acquire from outside, it becomes easy for the another very important aspect of intangibles is that how do I value them? Although this is not an accounting question, but yes, to put it on their balance sheet, the estimates of intangibles are very difficult. For example, the value of Apple's patent depend on somewhat, not completely, depends somewhat on China's continued willingness to allow the iPhone maker to sell freely in its market. Still, roughly 75% of S&P value stems from intangible assets when taking into account fluctuation. So when I'm saying patent of Apple is at a particular value and it is put in my balance sheet as an intangible, that patent would be valued at that price, and whether it will generate that kind of valuation will depend on whether China will continue to allow iPhone to manufacture and assemble on their land and sell it freely. which is a question mark. Similarly, if you see the value of Moderna's, which is one of the company which is developing the drug on coronavirus, uh, the value of Moderna's incorporation intangible assets heavily rely on the biotech firm's ability to develop and distribute a coronavirus. Look at the match. Moderna's market cap amounts to around 28 billion. Tangible book value, which can be found on the books, is less than 1 billion. That means 26.9 billion or 96% of Moderna's market value is derived from intangibles. That means 96% of the value of this firm is derived from a situation which is that they would be successfully able to develop and distribute a vaccine. People are buying it. Shares of Moderna have soared 265% this year. So not only their accounting is difficult, how do I value them is also a very nebulous proposition, because I'm not sure about what will happen, and what will happen will decide the valuation of these intangibles. Somebody was asking me a few days back, how is Jet Airways getting some price corrections? Huh? It is still hovering around 45, 40 rupees when absolutely all of their aircrafts are grounded. My typical response to such questions would be that the aircrafts have been grounded, but they still have the flying rights. Now, the flying rights, let's say from Delhi to London, a particular time slot which Jet Airways still has, is driving the price. Imagine this. This is intangible. A flying ride from Delhi to London is driving the value of Jet Airways, whose entire aircraft chain has been grounded. But still, the valuation is kicking in because they have a right to fly. And that right to fly is still attracting valuation. So that is how the problem is, how do I monetize that right to fly from Delhi to London in a particular time slot is a $1 million question, because we really don't know what is the value of that. And investors are always complaining about this because we don't have any valuation metrics for intangibles. And this is what the frustration is coming in. So you can always hear these kinds of comments. It's amazing how being long intangibles and short human beings has been such a winning trade. This is a sarcasm remark being made by one of the head of research investment at Bank of America, that it is amazing how being long intangible, long means buying, it's a derivative language which is being used, going long on intangibles and going short on human beings. You go short on things where you believe that the prices will fall. So they are going short on human beings and going long on intangibles, and that has become a winning trade. Uh, whether we like it or not, the economy is structured to reward asset light business models, which are not driving the valuations, and the valuation metrics has completely shifted. Uh, I would strongly recommend you to read these two books if you find time, The End of Accounting, because my presentation is quite influenced by what I read from these two books when we started talking about intangibles. So it is intangibles, intangibles, intangibles all the way. Tangibles will continue to lose their impact on the valuation matrix. That would be all from my side. Thank you.
Thank you so much for this very, very insightful session, sir. I think our attendees have really enjoyed and they have been really interacting with you so far. They have also posted a few questions, and if it's okay, we will go ahead with the questions that they have posted. Yeah?
Okay.
Okay. So one of them comes from Debrati Basu. They ask that they agree that intangibles are critical and visible change in the way companies are today. However, can this increasing difference between market value and book value be explained by aspects defining growth, which have also changed? They have also quoted an example. Growth earlier was restricted to geography. Now growth is global, and so growth estimates are also much larger. Earlier movement through business cycle from initiation to growth was much slower. Now it is much faster in tech companies, etc., which magnifies the annual growth rate even more. These changes have been made to valuation models as well. So would you like to take that,
Yeah,
please?
Yeah, that's absolutely right because the way the difference between market value and book value is largely ascribed to growth rates. Okay, future prospects and growth rates and the belief which the market has in the business model of the firm. So earlier, a growth rate of 10 to 15% was considered okay. Now, with the growth of these kind of businesses, the disruptive business models and the new technology companies, anything around 30-35% is also seen a fairly normal growth rate. If you look at the balance sheet of Google or Facebook and the way they grow every year on year, the 30-35% growth has become kind of a normal growth in this space. So you're absolutely right. The difference between the market price and the book value is largely guided by the growth rate, which has become exponentially large in the last 15-20 years. And that comes from the simple fact that a tech based company, I think I mentioned somewhere in my discussion also, that a technology based company, an IP based company, for them it is easy to scale. Scalability is very easy. If you have an app and you put it on a Google store or a app store, Apple store, it reaches out in one go, it reaches out to millions of people, which in the earlier space, you would require a distribution channel, you would spend so much on distribution network, and this is how the models have completely changed. So if I'm a restaurant and I try to tell people that I'm a restaurant, then I need donkey years to keep on telling them. If I put my restaurant on Swiggy's website, I reach out to million of people in just a few minutes. So that is how the scalability fact has become very, very crucial in tech based companies, and that is driving the uh, valuation, and the difference between book value and market value is increasingly becoming more and more alarming.
Great, sir. We have one more, which says, can banks consider intangibles as collateral for providing term loans, or that matter any loan?
No, the collaterals are not intangibles. Uh, Technically, they qualify because the banks have a right to access to to the collaterals in case the borrower defaults on the loan repayment. But no bank is ever valued based on the quality of collateral they hold. I mean, as they say in credit risk, that when we decide on a loan decision, it is never based on the quality of collateral. It is always based on the business proposal and the quality of the borrower. The due diligence is always done to find out the repayment capability of the borrower. Collateral is just a psychological cushion which banks keep as part of their compliance requirement, as part of their standard operating processes. But if any banker, you talk to any banker and you find out how difficult it is to liquidate these collaterals in case a borrower default. So technically, yes, but practically, very little relevance.
Okay. We have one more following in from Mr. Tanmoy. They ask, how will we take into account brand value and customer lifetime value in financial statements?
Come again, how will we?
How will we take into account brand value and customer lifetime value in financial statements?
No, they can't. That's what I'm saying. In the accounting standards, as of now, even if Pepsi believes that they have a brand which is more worth more than 5 billion, they can't really record it anywhere. That is the problem which I was highlighting, that internally generated intangibles cannot be recorded. If Pepsi is acquired by Coke, then on Coke's balance sheet they can record Pepsi as a brand and put a value on that. But till the time Pepsi has its own internally generated intangibles, brand, or customer lifetime value, they can't record. It is just going as a standard advertising expense, which is the accounting dichotomy which I am talking about. That when I generate it internally, you don't really reward me for that. When I acquire it, it is all there in the balance sheet. And that is something which accountants call it is a kind of a skewed or a bias towards internally generated intangibles.
Okay, so we have one more which says, can you please highlight the issue that how ESG performance or ESG disclosures can have firm value effects? Like, what could be the probable theoretical reasoning behind it?
The probable theoretical reasoning behind ESG reporting having an impact on market performance is that these companies which invest time and energy and money on issues which are critical for environment, issues which are critical for your employees, will be seen as better companies, right? That's the idea, that's the theory, that if a company is only driven by profit, if a company is only driven by margins and revenue growth, it is not seen as a good corporate firm, corporate citizen, if I can use that word. Whereas if you do something for the environment, if you do something for your people in terms of uh, providing something like in your office facility, if you create a facility for crush wherein employees who are young mothers can bring their infants, those things uh, can create value for the firm, and the investors see them as a better corporate citizens than firms which are driven purely by profit. So that's the theoretical argument, that firms who do such kind of initiatives are seen as better corporate citizens from the investor's lens.
So we have two very similar ones. One asks, is it not difficult to account for intangibles at the time of mergers? And a follow-up question is that which book do you think is really good to understand merger and acquisitions corporate strategy? If you recommend.
Yeah, yeah. The first one is definitely a very important question because we have been involved in some of these assignments where we try to advise firms on buy deal which they are trying to negotiate. It is always a very difficult proposition in terms of what should be the right price to acquire a firm which is privately owned and which doesn't have a market value in terms of it is not listed. So at the end of the day, whatever methods you apply, whether you apply DCF or whether you apply relatives or whatever tool, some rule of thumb, you have to arrive at some value. So we may not like that value, but then a value has to be decided. And once a value is decided, a price is settled for at which the deal is made. The buyer pays that price to the seller, and the seller transfers the assets and the liabilities to the buyer. That price becomes the value of the firm. So we have been doing many assignments where we put a price tag of X, and we have found that the buyer has actually bought it at 1.5x. It's perfectly fine. I mean, essentially, what is going to be the criteria which will decide the value is, as we always say, who is more desperate and who has better negotiation capabilities. The Excel sheets and the presentations can be modified accordingly. It is all boiled down to who is more desperate. Is the buyer getting more desperate or is the seller getting more desperate? And secondly, in terms of who is writing the check. So negotiation scales, desperation of buyer and seller, that would and at the end that will clinch the deal. It's not about the projections and the valuations which you make on an Excel sheet.
Any books that you can recommend on studying these, sir? One of them asks if there's a good book to understand such mergers and acquisitions.
There are so many books. I mean, there are so many people who do a lot of writing and all that stuff. I consider Ashwath Damodaran as one of the best people on valuation, and particularly more so because his entire intellectual property is free. I mean, you just need to log on his website and put an email, and you get access. So Ashwath Damodaran is the name to go for any understanding on valuation, right from scratch to advanced issues like valuation of private enterprise and all those stuff. So Ashwath Damodaran's book on valuation is the Bible. I would refer to him that book as Bible, and Ashwath Damodaran as God of valuation.
Perfect, sir. So the last question before we log off, Mr. Vishwa Ranjan asks, why are Indian PSUs valued so less by the market even those which are marking very high profit, such as oil marketing companies, even their tangible assets are not valued very positively.
Yeah, yeah. I know that's a very sad question to ask, and even a sadder question for me to answer, because I come from the old school where, again, we are not very comfortable with. I think Flipkart gets a higher valuation than HPCL or one of these oil marketing companies. What is actually bringing down the valuation of PSUs is the ownership. Actually, you have asked a very relevant question, because another intangible which makes a huge difference is ownership. So, who owns the firm? So, the PSUs typically are owned by the state, and that's a dampener on valuation, whether we like it or not, because investors in the market largely believe that if the firm is owned by the government, then there is lack of professionalism. The board would be handpicked by the state, and the decision making would be always delayed and maybe many times political, also politically motivated. So the ownership actually dilutes the valuation of PSU. Let me put it that way. And some of the people working in the PSUs are far, far better than what they are working in private enterprises. For example, in banking industry, if you look at the bankers in SBI, the bankers in some of these old public sector banks have far more better understanding and knowledge of the banking industry than these private sector bank guys. Like if you talk to a banker in Yes Bank, for example, and take him to talk to a banker in SBI, and I mean, he will be uh, destroyed in less than 5 minutes. But then, even though when you have superior employees with superior skill sets, but the ownership becomes a dampener, and because they know that even if this guy is brilliant in SBI, even if this guy is brilliant in Indian Oil, he or she would not be allowed to use their managerial skills or superior analytical skills to take a managerial decision, because the decisions would be taken largely by political and social objectives and not driven by profit objectives. So the ownership becomes a dampener in case of valuation, and therefore many PSUs uh, are valued at even less than the book value sometimes. The price book value is less than one for some of the PSUs, although on paper they would be very strong. So, again, another idea for how valuation becomes driven by an intangible, and this time the intangible is actually working against the stream. So, by and large, we were talking about going with the stream, and here is an intangible which is actually bringing down your valuation, which is ownership. So ownership is the biggest dampener in PSUs.
Okay, sir. So I think we've come to an end. Any parting words for the audience?
No, my only this thing would be that we should appreciate whatever is happening. As I keep on saying, we come from a school or a time when we were told that value comes from balance sheets and P&Ls of the firm, and gradually we are seeing that the P&Ls and the balance sheet are becoming irrelevant. So we have to accept this fact and kind of try to understand that there are business models who have evolved, which have kind of challenged the basic existence of or basic need of financial statement. So we should not be completely ignoring this, because I have seen a trend in people from my generation who graduated in early 2000, that we kind of try to pass a negative comment on these new business models and say they are all bubbles and it will burst and all. That practice should be dropped. We should appreciate what are good things which are coming up in new business models, and of course we can keep on talking about the best practices from the old school. So it has to be a natural transition where we have to come down from that level where we were, that only financial statements and whatever is there in the balance sheet will drive value, to a more comfortable situation where we accept that fact that there are intangibles which are not there in the financial statements, which are not reflected anywhere in the firm's performance. They are also driving the valuation. So that criticism of that valuation is a bubble and this valuation will not sustain, that criticism has to be dropped, and we have to accept the new realities of the disruptive business models. That would be my closing thoughts on this.
Thank you so much. Thank you so much, sir, for this amazing session. Thanks to all the attendees as well for joining us today in this discussion and being so interactive. We will be sending out your certificates for attendance as well as a recording for the session along with the presentation to your registered email IDs within 7 to 15 days. Also, in case you have any other doubt, please do write to us at support.india@mheducation.com. Till then, please stay tuned and thank you. Good evening.
Thank you. Bye bye.